Welcome back to our special series, Lehman Crisis 10 Years On. I've been speaking with Professor Kenneth Rogoff of Harvard University. Professor Rogoff, the issue we were discussing is an imminent rise in US interest rates and probably the global cost of capital. We've already seen dangers, or rather eruptions in countries like Turkey, Argentina, and now even the Indonesian rupiah is looking extremely skittish. Do you think that in the next 12 months we're going to see continued crises in emerging markets?
I certainly think we may see continued exchange rate volatility. Exactly what that translates into, whether we're going to see full-blown defaults, which Argentina is likely to have, or whether it'll be something less, I don't know. It's kind of interesting. If you go back a few years, the Russian ruble, it fell from 30 to the dollar to 90 to the dollar. It just collapsed. The Brazilian real went from 2 to 4, yes. and they had all kinds of problems, and yet they didn't default. It didn't lead to a full-blown default. So I think an interesting question is whether the exchange rate can be a cushion. Many people like myself have argued for decades that having flexible exchange rates, it might not be ideal, but it's a cushion against some of these problems. So it's not pleasant when your exchange rate collapses. It really puts a dent in domestic consumption. It's painful for consumers. But whether it's shorter lived than if you have a full-blown crisis, we'll see. There's a lot of corporate debt in dollars across yes. the emerging world. So when the exchange rates of emerging markets go down, it makes it harder to service these debts. But I think right now it's an open question whether the more flexible exchange rates, the inflation targeting, will prove sufficient. They haven't worked in Argentina because the Kirchner regime, which came before, just ran the country into the ground. They haven't worked in Turkey. I think it's very political. Turkey has the tools not to have a debt crisis, yes. but I'm not sure they have the political position to get out of it.
Oh, yes. It was political dictation to the central bank, perhaps, which wrought the crisis in Turkey. I wanted to move on to China, but it's tempting to stay on with this theme and bring it to India. We put in an inflation targeting framework about 2-3 years back. And at the moment, while inflation targeting seems to be working well, we have had higher than digestible trade deficits and a fear that the current-account deficit may get closer to 3%. And along with the emerging market crisis, the rupee also has been one of the worst performing currencies in the past 3 or 4 months. How have you studied India, and how do you rate the Indian macros? Do you think they will weather the storm?
Well, there's been a lot of structural reform going on in India, which hopefully will sustain long-term growth and hopefully make things better. The gross sales tax was a huge political and economic reform, financial inclusion. There's been a lot going on in India that I think will help. And although there is a lot of dollar debt, you're not at the level that many of the other Asian economies are. You're not at the level Turkey is at. So I tend to think if the exchange rate is allowed to move, it will prove a pretty powerful cushion. That's absolutely central to inflation targeting. You try to stabilize inflation, but not necessarily the exchange rate. That's the opposite of what countries did just 20 and 30 years ago. So I tend to think it's going to prove to be a pretty effective cushioning mechanism. But, one of the things that can get in the way is that the government, whoever's in power, gets cold feet as the exchange rate's falling and says, no, stop doing what you need to do with interest rates, stop inflation targeting. Then things can spin out of control. And that's easy for me to say as an economist not to do that. But if you're sitting there trying to manage the politics and manage what's going on, it's not easy. So I'm not saying India is going to have an easy time here, but I do think you have the right framework in place that moving to inflation targeting was and a more independent central bank, even more importantly. I think it's going to prove very helpful here.
Would the lesson for India from Turkey and others be that don't push the central bank too much, allow it the autonomy it deserves?
I think, you know, once you're integrated with financial markets, they're very sensitive to how you're treating the central bank. I'm not going to sit here and say never, never, never overrule the central bank. There are times where things get so bad, you have to allow inflation to increase a lot. You have to allow what we call heterodox policies. But I think at this moment in time, India is very well served by the framework that it has. And although it's very, very painful, look at Donald Trump's having a hard time in the United States,
yes,
leaving the Federal Reserve alone. It's very painful. I think that would be, for the moment, the best policy is to let the central bank do its job.
Okay. Well, let me come back to the Lehman crisis and the way it played out in the big economies, China and India. Here, perhaps there was a delayed reaction in terms of too much debt. How do you rate, you alluded to China. How do you see the Chinese economy? Do you see a hard landing? Do you see problems that might unsettle even the global economy?
Well, absolutely. I think it's probably the biggest single risk in the global economy. China is a very opaque economy. I think everyone has a view that, well, the government will fix everything. But there's a lot of debt out there. There's a lot of asset price inflation. And the government needs growth. If the government could just squeeze the economy for a couple years in a crisis and not have a problem, that would be fine. But I think that's very hard to do. I think it's the sort of compact between the Chinese leadership and its people is that we'll give the communist leadership, the Chinese leadership, a lot of power, but they're going to keep making things better for everybody. You go through a prolonged recession, that could be very tough. That's the kind of dynamic that could blow up into a bigger crisis, even though, of course, China will use state assets. They'll use the central bank's balance sheet. They will do whatever it takes to try to prevent it from blowing up. But it's not that easy to grow at 6 or 7% and be trying to contain this credit bubble. I don't think that can go on forever.
Okay. Finally, Professor, you know, we've had a fairly good rally across equity markets, both in emerging markets and in developed markets over the past 24, 36 months. Which are the biggest red flags that investors or even citizens should be worried about?
Well, you know, it's a little bit abstract, but I think this issue of what's happening to global inflation-adjusted interest rates,
okay,
if they stay this low, boy, stock prices can stay high, housing prices can stay high, growth can stay very strong. But if we start to see interest rates picking up for whatever reason, it can happen just because people feel less worried than they were, and so they shift out of bonds and into riskier assets. It can happen because growth is faster than people were expecting. I actually think growth will be better, particularly in the U.S., than people are thinking, and I've been saying that. That could push up interest rates, and then someone who had a lot of debt, whether be it a Turkey or an Italy or an Indonesia, South Africa, they could have problems adjusting.
Okay. But actually, at the moment, emerging markets are more worried about growth not staying so good simply because of the tariff wars. You don't see that having the potential to cool down growth. How do you rate the progress of tariff wars?
So as an economist, we think trade should be pretty much free and that everyone would be better off. But I think a lot of Trump and tariff wars is political theater. Most of his actions are playing to his base. He's making a lot of noise. The final changes are kind of minor tweaks. The big questions with China, whether something more serious will happen. But I think for the moment, trade wars are more theater in the Trump administration than they're actually something substantive. I must say it's so hard to opine on his policies because they change by the week. So it's hard to have a strong opinion. But I tend to think the tariff wars are more rhetoric than necessarily reality. If I'm wrong, yes, if Trump puts 25% tariffs on everything and all the other countries retaliate, that's going to be a mess.
Okay, well, I guess the United States has enough checks and balances for a president like Trump. But actually, one of the results probably of the global financial crisis has been the rise of such larger-than-life leaders. Do you think the very fact that there are these all-powerful leaders can lead to some kind of, a crisis because of ego politics?
Well, for sure, you can, if you concentrate power, you can end up with a bigger mistake than if you don't concentrate power. So the sort of retreat from more democratic leadership is something that for, someone like me is very disconcerting. And I don't regard it as a good trend for the long run. But it's here. I don't think it's something that's reversing anytime soon. I think a lot of countries are looking at China and saying, well, that's not so bad. They looked at the United States and democracy, but I think a lot of what was attractive was that the U.S. was wealthy as much as that it was democratic. So we've definitely had a stunning move away from democracy in Europe. You mentioned China. The United States, I hope not, but it's certainly a very difficult period.
Okay. Well, thank you very much, Professor Rogoff, for speaking to us on such an array of topics. Well, the key takeaway from Professor Rogoff, the danger to the global economy lies primarily in a potential faster rise in interest rates in the United States than the market is ready for, can be a potential danger for especially indebted countries. The second lesson, allow for as much central bank autonomy as possible. And a third lesson, watch out for China, a silent debt bomb ticking over there. Thank you very much for joining us in this special edition of our series, Lehman Crisis 10 Years On.